Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. In this video, we'll be talking about Peter Lynch, an American investor and the legendary mutual fund manager of Fidelity Magellan Fund. Over the course of 13 years, he had 29% yearly return, hammering the stock market. During that time, he was able to increase the size of the fund from $18 million to $14 billion. That is rather substantial. At the age of 46, he retired early. So let's learn from one of the greatest investors in history as he shares how to make millions during a stock market crisis, which is crucial to know in today's economic situation. So let's get into it.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
One of the rules that Lynch finds a useful excuse, or a few of the rules he wanted to throw up, is that a lot of people buy on the basis that if the stock has gone down this much, how would you know how much further down it's gonna go? When Polaroid fell from $130 to $100, people said, "Here's this amazing firm, great record. If it ever comes below $100, you know, just buy every share you know." And when it did, a lot of people bought on that basis, saying, "Look, it came from $135 down to $100. It's now $95. What a steal."
Within a year, it was 18. And this is a company with no debt. I mean, this is a company that was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to $16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, "Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now unfortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt.
It's tricky because some people may think it's a real achievement, but they had no debt and the entire company was selling for around $3 at about $75 million. And when it got to the point where it was the same as buying a Boeing 747, Lynch felt something was wrong with this company selling for $75 million. He was a little early at 16, but when he said it was okay, and it all worked out in the end, and they handed away all of their shares to their stockholders, passing out Kaiser Cement shares, they distributed shares in Kaiser Aluminum, as well as a public and private shares in Kaiser Steel. All of the other firms were sold, and you received roughly $50 for each share. But if you didn't understand the company, if you were just buying because the stock had gone from $26 to $16 and then to $10, what would you do if it dropped to $9, $8, or even $7. People's concern is that they sell stocks because they don't understand why they bought them. And then it goes down and then they don't know what to do. What do you do if you flip a coin and walk around the block? Here's the thing: when Lynch was asked in an interview if he was concerned about volatility in the financial markets today, and if he thinks there's something that needs to be done to reduce it, he answered, "I love volatility. I think I remember in 1972 when the market went down dramatically and Taco Bell went from $14 to $1. They had no debt. They never had a restaurant close and I started buying at $7. But I kept on to it and it went to $1. And the largest position of Magellan in 1978 was bought out for by $42 by Pepsi-Cola. I think I would have gone to $400 if they didn't buy it out. I think volatility is terrific. I think it's very terrific. I believe these callers are very important. I don't think that the market going up 80 points one day and down 80 in the next is a good thing for the public. I don't think that's a very good thing, but I think all these callers and all these other things to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years, and some event will come out of left field and the market will go down or it will go up. So for Lynch, there will be volatility, and markets will continue to have ups and downs. He believes that this is an opportunity for those who understand what they own. If they don't know what they possess, they can use mutual funds to figure out what they own and keep adding to it over time. In the past, basic business profits have grown at a rate of roughly 8% per year. As a result, corporate profits should double every 9 years, along with the stock market. So he believes the next market will be around 3,800 points. Today, 3,700, and he's quite confident that next it will be up to 3,800 points, not down. The following 500 and 600 points are undecided about which way to go. The market should double in the next 8 or 9 years, and then double again in another 8 or 9 years. Profits will increase by 8% per year, and stocks will follow. Lynch shared the story. October has always been a special month for him. In 1987, he was very confident that the market was not in trouble, so he was not worried or anything. He and his wife Carol had planned a golf vacation to Ireland. On Thursday night, the market dropped 55 points, which were not good. Then on Friday, they informed Lynch that it dropped by 112 points. He said to his wife that if the market goes down on Monday, they have to go back. So do you know what happened next? They stayed there for the weekend. Then on Monday, it went down 580 points. Lynch's fund dropped from 12 billion to 8 billion. They just watched the market deteriorate and there was nothing they could do about it. They went back home and suffered along with everyone else. And fortunately, Lynch said that the market went down 9 times when he ran Magellan for 13 years. And every time the market went down, Magellan went down. And he was 9 for 9. And you know, because it's very important, it's another one of these numbers you have to write down. If you invest $1,000 in a stock, the most you can lose is $1,000. He has done it several times, and if you're right, you can make $5,000, $10,000, or even $20,000. So in this business, you don't have to be right 1 out of every 2 times. Instead, you can be right 1 out of every 4 times. It's been a long time since you've been correct, and you're aware of that. When a company is doing well, you know they're doing a fantastic job, and you either add to it or don't sell it, which is a terrible strategy. You may earn more money on the upside. He flipped a coin to show when the market will be going down to 4,000. Will it be this year or the next? So the result was heads, so that indicated the market will rise in the coming year. That's all that Lynch knows about stocks, which also means you don't know what will happen. He just used the coin as an example to predict the market. Stocks will beat the hell out of money in 10, 20, 30 years. And they can beat the hell out of bonds. Whether you're investing for 4 years, 14 years, or 74 years, it's always important to ask yourself, what am I going to do when the stock market goes down? He never met people in the room that were short-term investors, because everybody in the world is a long-term investor until the market goes down.